Traders Corner is proudly brought to you by IG, the specialists in CFD trading.
Hello and welcome to Traders Corner. I'm Alicia Seckham, and as usual, Garth McKenzie is with us, taking us through his investment strategy. This week we're highlighting an option structure which Garth has created in order to give us some downside participation on the top 40 index with limited risk. Garth, nice to see you again. So what exactly are we looking at here?
All right, thanks, Alicia. Well, what I've got here is first of all, we're going to lay the scene with the chart of the top 40 index and basically paint a picture as I see it at the moment. And effectively what I'm saying is I think the market is at relatively high levels at the moment. It is quite overbought. We've been running hard for a couple of months now, and I think there's a possibility that we could stage some sort of a pullback or a correction at some point. But having said that, I'm very wary of being naked short in the market. And when I say naked short, I'm talking about basically putting a short position on, and if the market goes up, you lose money, and if the market goes down, you make money. What I'd like to do is try and put some sort of a structure in place such that we can have participation on the downside if the market were to pull back, but if it were to carry on moving higher, then I've got limited risk. And I've used an option structure to create that trade for us today, which we'll go through in a minute.
So, okay, you've outlined to an extent your strategy and the rationale behind it. Let's get into some of the detail then regarding these option structures because, upon my reading, it sounds pretty complex. Yeah,
it is fairly complex. Let's quickly have a look at the chart of the top 40, which I've got up on the screen at the moment. Now, what you can see there is we've obviously been, this is the trade over the last 2.5 years or so that I'm showing here. What's quite evident here is that there's a very clearly well-defined upward channel that the market's been trading in for the last 2 years or so. And you can see that we're heading up towards the top of that channel at the moment. The resistance or the top of this channel comes in at around about 40,500 to 41,000, that sort of area. And then at the lower end of the channel, we've got 36,000, which is approximately 10% down from where we are at the moment. And my suspicion, or what I'm effectively saying here, is that there's a possibility that perhaps if we do start to see the market pulling back, you can't rule out the possibility that at some point we maybe go back down to the bottom of that channel again. And that would probably be quite healthy for the market. Also keep in mind that the valuations on our market are fairly stretched at the moment. We on a PE multiple for the overall market of about 19 at the moment versus a long-term historical average of 14. So if you were to see some sort of a mean reversion on that at some point, it also talks to the fact that the market could stage a little bit of a pullback. And don't get me wrong, I'm not becoming a bear by any means, but markets don't go up in a straight line. Overall, in the longer term, I am still bullish. But I think that if we are to see a little bit of a pullback, I'd like to be able to participate in that. But at the same time, I'm a big believer in the fact that the trend is your friend and you shouldn't fight the trend, etc.
And that's exactly it, because there are two schools of thought at the moment. I mean, are we looking at the fact that a correction is imminent, or perhaps the beginning of new trends being set where earnings will eventually catch up and justify or warrant current valuations?
I think that markets move up and down. You'll find that, yes, earnings will eventually catch up. I'm pretty sure of that. But at the same time, now and again, markets do get a little bit overstretched, and then they need to retrace and consolidate a little bit whilst the earnings catch up. So given that, tying that fundamental story to the technical picture that I've painted here, I feel that there is there's a chance that we'll see some sort of a pullback at some stage into this area at the bottom of the channel here. And if that happens, if I'm right, then I'd like to participate in that. But at the same time, I don't want to be naked short in case the market continues to move higher as well. So in order to effect that sort of trade, I've created an options structure. These are tradable on the JSE equity derivatives division. You generally need to go through a market maker to effect a trade like what we've done here. But let's get into it and let's talk to the trade and look at the mechanics of what I've done here to effect this trade.
Okay, so let's go into it, because the first leg is the call option leg. So what exactly are we looking at on this front?
Yeah, okay, well, first and foremost, let me explain what this chart is that I've got up here at the moment. Along the bottom axis over here, you can see those are the levels of the top 40 index. So you've got 36,000, 37,000, 38, and so on. On the left-hand side here, we've got the profit and loss chart. So the first leg that I've done for this trade is a short futures position. I've done this on the December 2013 top 40 future. I've gone short of 2 contracts at a level of 39,800. Now remember that every 1 point on this futures contract represents 10 Rand. So by virtue of the fact that I've done 2 of them, it means that effectively I've got 20 Rand per point worth of exposure. And if you take that 39,800 points, times it by 20 Rand, you've come out at 796,000 Rand exposure. So effectively what you can say is that I'm short from this point over here at 39,800. If the market were to fall, that futures position makes a profit. However, if the market were to continue rising, that futures position incurs a loss. And that's the part that I'm worried about. I'm worried because this is effectively a trade against the trend. I'm worried about the possibility that the market does continue to move higher. And I want to protect myself against that risk.
Because it sounds like you're not comfortable at all trying to back that overall trend and the overall momentum that's driving markets at this stage.
I'm a big believer in trading with the trend, but at the same time, this trade, as we'll get into it and you'll see, this trade gives us very limited risk if the market continues to rally, but it does give us nice participation on the downside. So the next leg of this trade is a call option, which I've bought. I've gone long of a call option with a strike of 40,000, all right? And you can see the payoff of that call option there, the green line. Basically from 40,000 upwards, that option structure will start to make money. But because of the pay away, I've paid 10,371 Rand for every one of these options, and I've done 2 of them. So effectively what it means is that I've actually paid away a premium of 20,742 Rand in order to buy this call option. And by virtue of the fact that I've paid away all that premium, the market would effectively need to get back up to above 41,000 before I've overcome that premium pay away in order for this call option to start making some profits for me. So what I'm trying to say here is that that's quite expensive for me to pay that amount of premium for this option structure. So what I then want to do is the third leg of this trade, which is whereby I've gone short of 4 out the money put options with a strike of 37,000. And for those, I receive premium. Because I've sold these options, I've sold them to somebody else, I now receive the premium. And that effectively is the funding leg of this trade. And I've received 4,531 Rand for each of these put options. Because I've done 4 of them, it means that I've received a premium of 18,124 Rand. Yeah. So if you think about the net offset of those 2 premiums, I've paid money away on the call option, but I've received money on the put option. What it effectively means is that I've actually paid away net about 2,600 Rand for these 2 options.
So when it comes to that overall price tag, it's a price tag worth paying?
Yeah, it's very much a price tag worth paying because it's very small premium that I'm paying away to get a really nice, healthy exposure.
And basically what it puts in place is a hedge for you whether or not whether the market goes up or down.
Yes, well, exactly. So let's now, I know this looks complicated, but let's then overlay the net payoff profile of this thing. And that orange line that I've introduced there shows you the net payoff profile. And if I actually tidy this graph up now and remove all the other legs and just show you that payoff profile, there you can see it more clearly. So let's quickly have a look at this and analyze it. Effectively, you can see that the option premium that I've paid away is 2,618 Rand. That money is gone, I've paid it away, and I kiss it goodbye. Bear in mind that I'm short on the top 40 future from a level of 39,800. So I've basically got 400 points worth of risk on 2 contracts that I have to wear over there, which means that I've got a potential loss of 4,000 Rand on those 2 Aussie 40 futures before my call option then starts to come into effect to protect me if the market continues to move higher. Then we have this major area of profitability over here. You can see that from about 39,500 odd all the way down to about 34,300. That's our profitable area. And this structure makes its maximum profit at 37,000. And that profit would be 53,382 Rand. It then has what I refer to as a danger zone, which is basically below 34,300. That's where we would then start to lose money on this trade, and we would lose money at a rate of 20 Rand per point. But to give you an idea, if the market was to pull back to our sweet spot at 37,000 Rand, that would imply a market pullback of 7.5%. and it would then need to fall back more than 15% in order for us to fall into this danger zone.
And you don't see things pulling back that far?
No, I don't see them pulling back that far. Bear in mind, this is a December structure. It expires on the 19th of December. So it gives us around about 3 months worth of time to have this structure in place. And it's great protection to have, and it's very cheap if you think about it. So if we now transpose this whole payoff profile back onto our top 40 chart that we looked at right at the beginning and tie this all together. There's our top 40 chart that I explained in the beginning, what I saw there. There's the channel that I'd identified. Now, if we have a look, those lines that I've introduced there illustrate the salient or the most important strike levels for this structure. And if I now overlay that option structure onto this, you can quite clearly see here, if the market continues to move higher, then my risk is limited. The maximum that I can lose here is about 6,600 Rand, which is less than 2% of our available trading capital. If the market then starts to come down below 39,650, this option structure will start to make money for us. It makes its most profit at a level of 37,000, and bear in mind I said that's where we will make 53,000 Rand on this trade. And then those profits gradually start to become eroded if the market should fall back further, and then we move into danger zone below 34,350. Now, as you can see, the bottom of this channel kind of ties in quite nicely with our sweet spot on that option structure. So to my mind, this is a really nice way of taking a short position in the market without having unlimited risk, because a lot of people I know have been trying to short the market. They've been trying to short the top 40 in the anticipation that it's going to come down. And the trouble with that is that the upward momentum in our market is still so strong that a lot of those short positions are being squeezed out. And it's very difficult. By trading it this way, I've effectively given myself a 3-month window where I can participate in the short side. I don't know when the market's going to come down, but at some stage in the next 3 months, if it does come down, this structure will work very nicely for us.
In a very volatile environment, that's exactly what investors are after, limited risk. Is this accessible, though, to both your small and high net worth traders alike?
Well, it's more accessible towards the high net worth traders. Look, I know that the JSE are taking steps to try and make this options market more accessible to the retail traders. They have recently started putting some prices on the screens available to retail traders, but it's still very much a slow area of the market. To effect a trade like this, you typically need to contact one of the banks or one of the market makers that will make you a price in options such as these, and then assess the pricing and work out the payoff and so on. So to answer your question, it's not that easily accessible to everybody, but for higher net worth traders and more sophisticated traders, certainly these structures are available.
Even those sophisticated traders, though, may need a double take at all that you've outlined today. And you've got, in fact, a blog on your website that is accessible to explain all of this in greater depth.
Yes, well, that's right, because I know that these structures are very complicated, and to try and explain it in a 15-minute TV show is quite a big ask. So what I've done is I've written a blog article which more graphically and in more depth explains this structure. So if you go to my website, go to traderscorner.co.za, you'll see a link to blog on the left-hand side of the page there. If you click on that, you'll then see the article that I've written, which basically details all of the different steps and legs to this option structure that we've explained here today. So viewers can do that. And then you can also have a look at the video clip of this show, which is available on the Business Day TV website, and it's also reproduced on my website on traderscorner.co.za, where you can then go in, you can pause the video, and you can watch it over and over as many times as you like
so
until you understand it. So the two go
hand in hand there. At this point, Gart, let's get an update on the state of your portfolio as it stands this week. And just to reiterate, I mean, you've started with 250,000 since January, right?
Yes, that's right. We start every year with 250,000 Rand. This year has been going well. We're sitting at 354,000 Rand at the moment, so that's up almost 42% for the year to date. You can see just a couple of our recent trades. We had a nice profitable trade on the Aussie 40 there, and then we lost a bit of money on the Rand dollar exchange rate. And now this trade that we've done this week is this option structure, and you can see the 3 legs of that option structure all detailed there in the positions report.
Quite a performance, that close enough to a 42% rise for the year. You've got to be patting yourself on the back. Let's go through your course dates. I mean, you've got courses scheduled for Johannesburg and Cape Town?
Yes, well, this week on Thursday, we've got Understanding CFDs course on the 3rd of October. It's an evening course. It's 2 hours long this Thursday evening. And then my high probability trading course, I'm running one this week, Friday, in Johannesburg, the 4th of October. That's a full day course. And then in Cape Town next week, Saturday, on the 12th of October. So anybody that's interested in attending one of these courses, you're welcome to email me, garth@traderscorner.co.za, and I'll then send you the details.
Perfect. Garth, thanks so much for your time. Always a pleasure chatting to you. And of course, if you need any further information, you can access all of it on Garth's website, traderscorner.co.za. Garth is founder and editor of Traders Corner, of course. Until next time, goodbye.
Traders Corner is proudly brought to you by IG, the specialists in CFD trading.